Just let it rest. Okay. Calculator, you're gonna need it. I'm just showing this page because I'm not doing it just yet. If time allows, I will do this, but this is called, can you just write down reverse mortgage calculator. If you ever want to go and figure this out, it's basically saying, hey, I can afford a payment of $1,400 a month. What kind of a house price range can I afford? Right? So it's like you're reversing the process, right? So look up on Google reverse mortgage calculator and you say, hey, I can make $1,500 a month. What kind of a house can I be looking for at that price? Right? Like what is it, 200,000, 250? What can I? So that's what this is doing. But I find it a little pointless because it's so much easier to do it online, and it's not a requirement for you to know how to do this when it comes to the province. So I'm just going to leave it there. 16, we'll just do, I don't know, omit for now, right? So you're not flipping through it and being like, oh, why is this blank? Should I have done this, right? So we're just going to omit it. This is important, but right now I want to go straight to calculating a mortgage. But if you go to page 18, watch this. This is I'm just going to highlight a few things because they all mean the same thing. The initial startup cost, right? And this page, as well as the next one, talks about one-time or sometimes called closing costs. One-time or closing costs, they mean the same thing. When you close a deal, like when you're about to buy the home, you're closing the deal. There are things you need to pay for when that happens, guys. A lot of money. You will see, it's kind of scary. So watch this. You need to save up an additional 2 to 4% of the purchase price on top of your down payment, right? The biggest expense will be the down payment. Highlight that too. You need a down payment of 5% minimum. The bank will not approve anything less than that. And then on top of that, it's recommended that you have 2 to 4% to pay for all of these things that come up. Okay. Let's have your highlighter ready because I'm just gonna glance over this. I won't spend too much time because I know you're just waking up, right? But home inspection, guys, that is important. Before you make a decision to purchase a home, it is highly recommended that you have the house inspected by a professional inspector. Okay, and I will say this: it's not here, but I will say this: add this to your offer to purchase. I have the exact wording here. Write it down on the side here. Okay, on the offer, include. Right? There has to be a clause. Tell your lawyer that you will buy the house pending inspection. Obviously, it's going to be longer than that, right? It's not just going to be, but there should be on your offer to purchase. Let's say you're buying a house for $370,000. Somewhere on there, you should say, "I agreed to buy this house if it passes the inspection." I hate to tell you guys, it's a couple $100. It's $300 to $500 to hire an inspector. What do they inspect? They inspect the roof. They inspect the attic. Do you know what the attic is? Anybody? It's between the ceiling. This is the ceiling, right? And then there's the roof above the ceiling. That space that you can actually access, you can actually walk in there for a lot of houses. You can tell if there's maybe like if there's water coming through the roof. If there's leakage, you can inspect for that. If there's enough insulation, are the basement walls okay? Is there anything majorly wrong with it? Wiring, okay? So I'll just do this. Wiring, basement, roof, attic, etc. Sometimes you can pay less for so the inspector only inspects, like they say I have 5 things that I can inspect for you. If you just want me to inspect 3 things, I'll only charge you $300, right? But make sure you do that. It's worth it. A lot of people say, oh, it's a lot of money. I don't know. It would suck if you buy a house and then you find out there's a crack in the basement foundation, which costs thousands of dollars to repair, right? Um, Sometimes you need to pay the appraisal fee. What is that? The lending, right? The lender must determine the value of the property. Especially now that people are overbidding like crazy, the banks are saying, hold it. What? You bid 450 for a house that was worth 370? We need to send somebody down there to actually make sure the house is worth what it is. And they did that to my house. They came in and they actually checked there. It's basically an old, like a former real estate agent that now works for the bank. So they check everything. They check everything. The walls, is everything in working order? How much would it actually be worth? Okay. Mortgage application fee. You know what? I'm not going to highlight that because most banks don't charge you anything because they really want your business. So don't worry about that. This is important. Land transfer tax. Okay. When are you required to pay this tax to the Manitoba Land Titles Office? Right? At the time the title of your home is registered. So when it comes from you, if it changes hands, if that property changes hands, you have to pay land transfer tax, which is very expensive. We will calculate that exactly. And don't worry about this chart. It's scary right now. We won't worry about that. Survey certificate. Okay. You might be able to obtain this document from the seller. If you require a new one, okay, it would be approximately $300. What is a survey, property survey? What is it? Okay. It provides information on how buildings, fences, and other structures are situated on the property. You know what people sometimes find out years later? That the fence they built is not where it's supposed to be. You're like a foot or 2 feet over on your neighbor's side. My neighbor told me last year, hey, did you know that our fence goes 1 foot into my property? So technically, I own a foot of your property. And I was like, whoa, really? He's like, yep. But don't worry about it. I won't make you move the fence. But it sucks to know that it's technically and so the survey tells you exactly where things are supposed to be, exactly where your property starts, where does it end, how far in does it go, things like that. I know that and especially in like rural Manitoba, back in the days, farmers just built their barns like, hey, I think it's about right here, and they literally had to like take the whole barn down and move it over like 10 feet because they were in their neighbor's property, right? So a survey lets you know what that is. I have one. So whoever buys the house from me wouldn't have to pay this because I could provide that, right? So it was passed down to me as well. Legal costs, guys, that's huge, right? And there it is, lawyer fees. Why do you need a lawyer? Okay. They will charge you $300 to $400 to do legal work involved in the purchase of your home. You need a lawyer when you make these transactions. Okay. Real estate lawyers, they make sure that the titles get transferred properly. And yeah, they charge $300 to $400, maybe even $500. That's a lot of money. It adds up, right? It's a one-time payment. Yeah. unless you're consistently in trouble with the law. Then you should maybe do a payment plan. Page 19. I'm just gonna do this one, page 19 here, and then we're moving on. Interest adjustment. What in the world is that? Let's read this carefully here. If you require mortgage, the processing time required by the land titles office means that your mortgage money is not released until after you take possession of the new home. During this time, you must pay interest to the seller. Here it is. You must pay interest to the seller. As a rule, you pay 1 month's interest to your lawyer when you take possession of your home. So let's do the math here. Let's say you buy a house that is $350,000. I'm just making this up. Remember how to find the interest for 1 month, guys? Do you remember that? Your unpaid balance times the interest rate right now is about 5%. We divide that by 12. So you would pay about $1,400 in interest to the previous owner because it takes this long for them to actually get their money. It's complicated, but basically, guys, this is your lawyer. This is the other person's lawyer. You can't just give the money straight to that other person. It goes from your lawyer to the other lawyer, and then that lawyer gives it to the seller. You're the buyer, so you give the money to your lawyer. That lawyer gives it to the other lawyer, and then that lawyer gives it to the seller. It's just because it's a large amount of money. That's all I'm going to say for now. We'll leave the rest, okay? Keep going. CMHC mortgage loan insurance, I'm going to talk about that later. But you're going to have to pay that most likely. CMHC. That's on page 21. But keep going with me. I'm going to skip some of that. Go to page 23. Understanding mortgages. That's what I want to focus in today. Highlight that. Understanding mortgages. Okay. So what is a mortgage? It's a loan to finance the purchase of real estate, usually with specified payment periods and interest rates. Amortization period, it's the length of time, right? Length of time that you're going to pay off the mortgage. Most mortgages are paid over 25 years, most of them. You might be able to pay it off faster, but equity is the portion of the value of the home that you own. We talked about equity yesterday, and you know what? I'm going to keep talking about it because it's somewhat of a complicated concept. Interest, obviously, the finance charge, the total interest paid, okay? Principal, the amount owed, oh sorry, borrowed. I'm going to put borrowed here. Borrowed, also called the mortgage amount. Unpaid balance, the portion of the value of your property that is owed to the financial institution. Your down payment, the amount of money that is put towards the purchase of the house. The minimum amount is 5% in Canada. $23. Let's say here you buy a house worth $200,000. You make a $25,000 down payment. How much is your mortgage? Here we go. It's $175,000. That is the mortgage. That's how much you're gonna have to borrow to pay the house. You pay 25, the bank gives you 175 to pay off the rest. In this case, guys, the equity in your property at the very beginning is 25,000. You literally only own 25 grand of the house at that time. The unpaid balance is what we would consider the 175,000. Right? The unpaid balance is also the mortgage at the very beginning. Calculate the down payment as a percent, and I will test you on this. This should be a slam dunk. So basically what you do is you take 25,000. It's like your test score. I have 25,000 out of 200,000. Multiply that by 100. It's exactly how you would do your test score. Okay, so you go 25,000 divided by 200,000. And that would be times 100, right? That's 12.5%. So in this case, you've saved up more than the minimum, which is good, right? Don't just go with the bare minimum because you're going to need more for the extra costs. And guys, this is just to inform you a little bit here. It gets probably a bit more complicated than that, but there's two rates available when you get your mortgage. Something called fixed, right? Fixed rate or variable rate mortgages. And the name kind of says it all. The name tells you what's happening. A fixed rate mortgage is a mortgage where the interest rate is unchanged. I forgot the is, unchanged. Is unchanged for the specified period of time. Let's say when you choose a 5-year term, you're guaranteed to keep that interest rate for that time frame. It's also known as a closed mortgage. Like you can't really make changes to it. You're stuck with it. Variable rate, a mortgage where the interest rate may vary from month to month. It's also called an open mortgage. And look at the interest rates here. So a 1 year, a 3 year, or a 5 year, and I have a bunch of credit unions here. And you can tell, watch, for Access Credit Union, a 1 year mortgage would be 5.59%, 5.49 for a 3 year, and still the same for a 5 year. So you decide how long you want to lock in for. Most of the time it's 5 years. People go with 5 years. And it varies from bank to bank, right? This is just recently that I got this. Not too long ago, a year ago or a bit more, I signed a 5-year mortgage for 1.9 something percent, which is crazy to think that now we're at 5. No, I had a 1.9 and now it's 5. So the higher your interest rate, the more you're going to pay. So it's not good. Yeah. Okay, keep going. Yeah, it's gonna be, just gonna have to try to follow along, okay? I have 2 highlighters for this page if you want to do the same as I do. How a fixed mortgage works. If you lock in for 5 years and you decide to sell the home before the 5 years are over, you will pay a penalty. You will pay a penalty because you're breaking the term. It's like a cell phone. If you want to get out of the contract, you have to pay that penalty that remains, right? So this is how it works. If you have imagine you're going to pay this mortgage off over 25 years. It could be that for the first 5 years, you sign for a 5.49% interest rate. At that time, close to the 5-year mark, your bank is going to send you a notice saying you can now refinance, renegotiate. And let's say at that point in time, you luck out and you get 3.78%. Now you're stuck again for 5 years, and then the process continues. You sign, and I say, hey, how about it now goes up to 6.75? I hope not, but let's say that happens. Then another 5 years go by, you need to re-sign, and let's say for this chunk, you get an interest rate of 2.9%, which is awesome, right? And then the last 5 years of your mortgage, you get an interest rate of 1.75. But every time these 5 years, you're stuck with that rate until you sign again and you're stuck for 5 years, and so forth and so forth. But let's say 5 years go by and you think you're gonna move. You're like, you know what, I want to move. When it comes time to re-signing here, you might not want to go for a 5 year. You might just want to keep it open, or you might just go for a 1 year mortgage. All right. So that's always up to you how you want to do it. But this is 25 years in total. We got that. So basically on top here, we're going to go 5 year term. 5 year term. We always went for a 5 year term. That's how most people do it. I don't know. But you can do whatever you want. Some people keep it open the whole time. However, let's say I had kept it open 2 years ago when I refinanced, and all of a sudden the interest rate goes to 5.5. It was 1.9, but it's 5.5. Then you're stuck. Like, you have to pay whatever the current rate is. Versus if you lock in, no matter what happens, you're kind of guaranteed. You're guaranteed that rate. So let's go a different scenario, guys, because it's important for you to know this, okay? Let's say 5 years go by and you're like, you know what? I want to start from scratch. I want to go 25 years again. So you re-mortgage. You start from scratch. So technically, these 5 years here went by. We're going to tack that on here. Right? 5 years went by. But you're saying, I want to start again and take another 25 years to pay everything off. Can you do that, Mr. Dirksen? Yep. I know people that do it all the time. I would be careful with it, because then you might be 70 years old and still have a mortgage for 25 years, right? And you don't want to be in that situation. But basically, this is where my second highlighter comes in. Right? This would be 30 years total. 30 years total if you did it like this. Right? Versus this one, it would have just been 25 years total. No, they take that. They're like, thank you very much. They take whatever you paid them. You've paid down your house a bit, right? But you start again another 25 years. And why would you want to do this? Why do you think people want to start 25 again? Any thoughts or comments? Why would you want to remortgage for another 25? Yeah, that could be. But this is actually, what do you think happens when you, let's say you make a payment of $2,000 a month. You pay off your mortgage, and then you say, hey, I want to start another 25 years. What's going to happen to your payment? You're going to pay less a month because you're resetting, right? You owe less, and now you're saying, hey, I want another 25 years. So here it is, the refinancing, right? Remortgaging. Will lower your payment for sure. However, it's like this comedian says, nothing good ever follows however, right? You should just tell the person, stop, stop, don't say what comes after that. I don't want to hear it. Right? However, the total interest paid, oops, the total interest paid will increase. That is what I want you to know. I've done that myself. I was, they call it your house poor, meaning you have all your money in the house. You need money to do other things, right? You need money for groceries, you need money for other things. So, allows for more cash flow, right? Remortgaging allows for more cash flow. Okay. And some people are like, just an extra 5 years, instead of being done at 60, I'll be done at 65 with my mortgage. It's not a big deal. That's probably right, but there's a lot of interest you will be paying doing it that way. You're tired already, right? Let's just finish this page and then I'll leave you alone. A house or real estate is considered, right? A house or real estate is considered an appreciating asset versus a vehicle which would have been a depreciating asset, since it generally increases in value over time. This is due to the fact that there is a limited supply of houses, but an increasing demand for them. So low supply and high demand will always drive up the cost of something. Always. Low supply, high demand. Like, that's why everything went up like crazy over COVID, right? Because there was low supply and high demand. So the manufacturers, they're like, sweet, I'm gonna like capitalize on this, right? So they drive up costs because you're willing to pay it, right? Like toilet paper, right? Anyways, owning a house or condominium has its advantages, but there's many additional costs involved. The initial startup costs are greater, like your down payment. You're responsible for all repairs, maintenance, and bills. One should keep these in mind when considering owning real estate. For some, right? For some, renting is a much more feasible option. Startup costs are lower. Most utility bills are included. It's much easier to relocate if needed. And major repairs and maintenance are the landlord's responsibility. Okay. I honestly don't think that you should buy a house right away unless you have the money, unless somebody says, here's 50 grand, have fun, right? But renting is probably at first an option for you. Maybe living at home, saving up first, right? So forth. So we're going to talk, we're going to actually calculate the payments tomorrow. Thank you for listening.